At the start of November, the Reserve Bank of Australia decided on its 13th rate hike. After pausing rate hikes 4 times, the interest rate was increased by 0.25%, reaching a new peak of 4.35% in this current round of hikes. 2 weeks after the hike, the Reserve Bank of Australia finally published the meeting minutes, and the next day the governor came forward to explain the reasons for the rate hike publicly. While the interest rate increased, the overall Australian housing market experienced a V-shaped rebound, surpassing the peak housing prices during the pandemic and reaching a new historical high. The governor of the Reserve Bank made an unusual statement, warning that the Australian economy might face greater challenges in the future.
I think inflation is the crucial challenge over the next 1 to 2 years.
Has the rate hiking process ended, or has the second wave of rate hikes just begun? How will the Australian real estate market develop, and should one buy a house now or wait a little longer? Hey there, my name is Alex. Welcome to my channel, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. Before the rate hike, various economic data had already been released, such as the inflation and unemployment rates. Financial markets and economists had their speculations, but why the central bank decided to hike rates and the consideration it took can only be understood after the release of the official minutes of the rate hike meeting. This also provides a basis for us to make informed predictions about future interest rate trends and the resulting housing price trends. I've read the entire meeting minutes, including the speech by the central bank governor, the next day. The central bank's considerations mainly include the following aspects. Firstly, there is a factor of inflation. In the past few months, Australia's inflation figures have been decreasing, heading in the right direction, but the magnitude is smaller than the central bank's expectations, and the pace of decrease is somewhat slow. If this continues, the central bank fears that it won't be able to reach its set target of bringing inflation back to the 2 to 3% range before 2025. Therefore, further rate hikes are necessary to ensure the pace of inflation declines aligns with expectations. Secondly, compared to the other countries with similar systems, problems, and economic conditions, Australia had the lowest interest rates but the highest inflation. For instance, the United States had an interest rate of 5.25% to 5.5% with 3.2% inflation. The United Kingdom, 5.25% with 4.6% inflation, and Canada, 5% with 3.1% inflation. Before the hike, Australia's rate was only 4.1%, yet inflation was at 5.4%. Thus, from an international perspective, Australia's pace of rate hikes was relatively moderate. Compared to the other countries, there was still significant room for rate increases. According to estimates by the central bank staff, the pressure of mortgage repayments in terms of the proportion of household disposable income is not as high as it was 15 years ago. This means that compared to the interest rate hike cycle before the 2008 subprime mortgage crisis, people still have money in their pockets. Even after making repayments, the remaining disposable income is more than what it was at the time. I'm not surprised by the central bank's statement, as in economics, overall efficiency is prioritized over human factors. However, comparing the current economic situations to 2008 surprised me. I started to wonder if an economic collapse similar to the 2008 subprime crisis could happen again. The central bank also added that a considerable number of people with fixed interest rate mortgages will roll into more expensive variable interest rate loans, but this will not have a significant negative impact on their ability to repay. The central bank believes that the so-called fixed-rate mortgage cliff is essentially a misconception or pure speculation. And in reality, it won't impact the vast majority of people because they have money to afford higher loan repayments. So, the central bank made the decision to raise interest rates. Personally, I think this decision to hike rates is the right move. Although it increases people's repayment pressure and living costs, it can curb demand, reduce consumption, and thus lower inflation. I predicted this rate hike in the live stream. The current governor is very decisive, not hesitant like the previous one, who avoided or slowly implemented rate hikes, leading to an endless rate hike process in Australia. If the current central bank governor had taken office earlier, perhaps the interest rate would have already been raised to 5% and inflation would have been brought down, preventing the sudden start of rate hikes after 4 months' pause and the subsequent blow to the real estate market's confidence again. The reaction to the Australian second-hand housing market is very direct and visible to everyone. The measure of the heat in the second-hand housing market is quite simple. It's the auction clearance rate. The national average clearance rate, as well as those in Sydney and Melbourne, have all entered a brief plummet. The new housing market has always been harder to judge, as sales volumes are only known to developers or builders, and if they don't talk, no one knows. However, this time, the developer and Australian-listed company AV Jennings, in an interview with the Australian Financial Review, said that this rate hike directly hit the demand for new houses. Sales of the new houses were very good in the past 4 to 5 months, as the interest rate remained unchanged and everyone's confidence gradually built up, believing there would be no further rate hikes and monthly repayments would not change. However, this rate hike shattered people's illusions, and many buyers began to reassess the market trend. AV Jennings, which has developed projects in Australia and New Zealand, sold 20% of its properties to investors this fiscal year. Although they didn't say how much their new house contracts decreased after the rate hike, the entire interview revealed their full resentment towards the central bank, suggesting a significant drop in sales. In New South Wales, Sydney, sales have dropped the most. Even registered land is not selling well, indicating that affordability has reached a tipping point. So, given the current economic situation in Australia, are we at the end of the rate hike cycle or just at the start of the second round of rate hikes? What will be the trend of the Australian housing market? Should we buy now or wait? The day after the central bank released the meeting minutes, the governor issued the supplementary statement. In the early and middle stages of the pandemic, Australia's inflation was indeed caused by logistics and international supply chains. And at that time, local Australian interest rate factors had limited impact on controlling inflation. But the main cause of current Australian inflation is no longer international import inflation, but local Australian factors, where interest rate factors can play a greater role in controlling inflation. If we scrutinize each item in the inflation measure, we see that about 80% of the items are now above 3% inflation. So inflation is not caused by just one or two factors, but exists in most aspects of the economy. Currently, inflation caused by domestic demand in Australia has shifted from goods to services, including rent, insurance, finance, dining, home services, and telecommunications, with nearly every service experiencing high inflation levels. People's desire to purchase physical goods has significantly decreased, instead focusing on service consumption. Historically, periods of rising service consumption are the weakest periods of economic growth, as people prefer to spend money on happiness rather than goods. The rise in service inflation is caused by local Australian factors, such as labor costs and shop rents. If Australia increases wage again, service inflation will continue trending higher, and the central bank may be forced to hike rates again to suppress inflation. Then, the most feared scenario of simultaneous wage and inflation rises, then a death spiral will form, and a high inflation and high interest environment will persist. The third observation is Australia's labour underutilisation rate, which is inversely proportional to the level of service inflation, meaning it's hard to find labour, so companies' human resources are being utilised to the maximum efficiency. At this point, if market demand increases, rather than expanding production scale and hiring more people, businesses are more willing to raise the prices of goods and services, or in other words, use price increases to reduce demand pressure and simply boost profits. So the solution to inflation is either labor becomes easier to find, rising unemployment rates, or demand decreases with people no longer consuming in a high-interest environment. Local Australian factors are the main determinants of current and future inflation. To bring down inflation without further rate hikes, we need wage growth to be lower than inflation, more labor, rising unemployment rates, and decreasing household disposable income. Otherwise, the current high inflation and high interest environment will continue. But don't worry, even if this phenomenon occurs, Australia might have to start cutting rates to stimulate the economy soon. Is this the final phase of interest rate hikes in Australia or the beginning of a second round? Personally, I lean towards the former one. The most obvious point is that major countries like the United States, United Kingdom, and Canada are nearing the end of their rate hike cycles. As a global interest rate indicator, the US has reached the peak of its cycle. Last month, the US reported zero month-to-month inflation, effectively no inflation, and only 3.2% year-over-year. Almost all industry leaders and financial experts agree there's no need for another hike. Inflation levels in the UK and Canada are also on a downward trend, with UK inflation particularly in free fall, soon raising concerns about deflation. Australia must consider US rates in its policy decisions. Failure to align could lead to fluctuations in the Australian dollar, international trade, and investment shifts, far scarier situations than domestic inflation. Moreover, with the recent decline of the US dollar and the rise of the Australian dollar, a strong Australian currency increases international purchasing power, making foreign goods and services relatively cheaper, which could ease domestic inflation pressure. In summary, I believe this Australian rate hike likely signals the end of the rate hike cycle. Of course, I could be wrong, as firstly, the central bank's rates still have room to rise compared to other countries. Secondly, Australia's strike culture could continue to drive wages up, further boosting inflation and triggering more rate hikes. Regardless, we should re-evaluate our home buying decisions and plan ahead. Australian housing prices have reached historical high, especially in Sydney, Brisbane, and Perth. You might think, since they're at all-time highs, why not wait for prices to drop before buying, especially when the interest rate is also at the highest level? Many people think this way. In my view, this is pure speculation, a subjective belief that the world revolves around oneself. Well, yes, current prices in several cities are at historical highs, but how can you be sure if prices will go higher or lower in the future? How can you accurately predict the price turning point? Looking at the history of Australian housing prices, while there are short-term fluctuations, prices have consistently risen in the long term. Each time there's a short-term dip, the next increase exceeds the previous peak. It is true that the current rates are at the highest in over a decade, but no one, including economists, financial advisors, and seasoned real estate investors like myself, can predict whether rates will go higher or lower. Our forecasts are merely educated guesses. But the overall trend has already formed, and I believe my prediction has a high chance of being correct. In real estate investment, one shouldn't overly concern themselves with short-term market and interest rate trends. Instead, base long-term plans on historical experience using average interest rates, growth rates, and rental yields as benchmarks. It is much easier to earn money from a 15 to 20 years investment than a 1 to 2 year speculation. My advice remains the same. If it's for owner-occupying, buy whenever you find something good and affordable. If you can't afford the current high rates, it only means it'll get easier in the future. Investors should focus on their own circumstances. As long as it fits their investment plan and they have sufficient cash and loan capacities, buying and holding is the way to go. If you made it this far, please give me a thumbs up, subscribe, and share this video with your friend. Turn on the notification bell to watch new weekly videos. Have a good one. Bye.